Everyone likes a good deal. The same goes to legendary stock investors like Warren Buffett and Peter Lynch when they identify which stocks to buy. The technique they and millions of investors frequently use is called value investing. Value investing is buying stocks when their market share is below their intrinsic value, aiming to sell them later when the market value reflects their true worth, much like hunting for a good discount. For example, imagine Apple stock is trading at $200 per share in the stock market, but you believe its true worth is $300 per share due to its growth potential and breakthrough technology. If you buy a share for $200 today, and a year from now, the market recognizes Apple's true value and the price rises to $300 per share. You can then sell it and make a $100 profit. Now, it's easy to tell what the market value of Apple is given that you don't live under the rock. What's tricky is how do we determine intrinsic value of Apple as a company? Benjamin Graham, known as the father of value investing and Warren Buffett's mentor, defined intrinsic value as a company's true worth based on its fundamentals, independent of current market price. It's essentially the present value of all the future cash flows a company is expected to generate. This is easy to say on paper, but in practice, it's extremely difficult to predict all the future cash flows of a company and use the appropriate interest rate to discount it back to the present. Despite this difficulty, intrinsic value can still be approximated through a thorough analysis of a company's business operation, management quality, growth objectives, and of course its financial statements, including its earnings, cash flows, assets, and liabilities. Professionals often use key valuation multiples such as price to earnings or price to book ratios to gauge whether a stock is undervalued. For instance, if company A has a PE ratio of 10 times, it means investors are willing to pay $10 now for every dollar the company has earned. If company B trades at PE ratio of 15 times, investors are paying $15 now for every dollar earned. Keep in mind that the company is expected to generate future cash flow, so a big chunk of the $10 or $15 is invested in the company's future prospects. Now, if both companies are similar in all other aspects, company A might be considered undervalued compared to company B. Unfortunately, reality is often more complicated, and more often than not, when a stock is trading at a higher valuation multiple, it usually possesses a desirable characteristic that investors like. Your job as an investor is to determine whether or not the investor community is paying too much or too little on these different characteristics among companies. A key concept in value investing is the margin of safety, which means buying stocks at a significant discount to their intrinsic value. The word significant is the key here. This provides a buffer against errors in valuation or unexpected adverse developments, thereby reducing investment risk. Essentially, you don't need to be precisely correct to profit. You just need to find stocks where the gap between market value and intrinsic value is wide enough to ensure a potential profit. Value investing is about buying stocks that are worth more than their current market price and holding them until the market recognizes their true value. While determining intrinsic value can be challenging, thorough analysis and a focus on fundamentals can help identify investment opportunities with a margin of safety. By focusing on undervalued stocks, value investors aim to minimize risk and maximize potential return, making it a powerful strategy for building wealth over the long term.